This lesson is a follow-up to lesson 1 that we have just concluded. And in this lesson, I'm going to use a simple example to illustrate the concepts that we have learned in lesson 1. Especially, I'm going to illustrate how to determine the goodwill on consolidation, minority interest, group retained profit, group preference shares, and also the loan stock. So here you're going to really learn how to prepare the cost of control account and determine the 5 items below. You find that this is a simple example. It's because I want to start with the beginners in the first lesson as I advance going forward. Expect that as I advance, I will be looking at more complicated examples or more advanced examples, which shall be having a lot of comprehensive illustration. I will also use questions from CPA past papers, but that will come after I have introduced and maybe explained the concepts well, so that the concepts are very clear to those who are following these lessons. To illustrate the concepts in this first lesson, I've adopted a very simple example. Even though later, as I explained, I will be answering consolidation questions from CPA past papers. But for this particular lesson, I want to illustrate using a very simple example because I want to start with baby steps, and then later we shall advance as we continue. Right, the example reads as follows. Set out below a draft statement of financial position of Home Limited and its subsidiary Safari Limited as of 31st December 2021. So we have Home Limited here, noted H, and Safari Limited, noted S Limited. Non-current assets, we have tangible PPE, and we have investment in S Limited, whereby investment in S Limited is ordinary share capital here, preference share capital, and loan stock. Current assets in both S Limited and H Limited. And then we have total assets. Share capital, which is ordinary share capital and preference share capital, and then retained profit in both S Limited and H Limited. Then we have non-current liabilities, that is a loan stock, and also we have the current liability, which is account payable. These are a simple example, as I've said, very, very basic example and simple. Right, we are told that H Limited acquired 60% of ordinary share capital of S Limited when the retained profits amounted to 1,000 shillings, and 40% of preference share capital and part of 10% loan stock. So what we can understand there is H Limited acquired 60% of ordinary share capital of S Limited. You can see here, ordinary share capital of S Limited is this. H has acquired 60% of them. Also, that the time of acquisition or the retained profits of S Limited were 1,000. Now they are 4,000, as you can see. We have been told that H Limited acquired 40% of preference share capital of S Limited. Preference share capital of S Limited are 12,000. 40% belong to the parent company, meaning 60% belong to the minority. Right. We are required to prepare a consolidated statement of financial position of H Limited and its subsidiary S Limited on 31st December 2021. For us to answer that question, we must first prepare some adjustment. And the first adjustment we want to start with is what is known as cost of control account. In the cost of control account, we have the following. We can prepare the cost of control account using the vertical method or sometimes even the T account. If we are using the vertical method, we start with the investment in S Limited. Investment in S Limited is a total of 12,000 plus 10,000. Remember, we said that loan stock should not go to the cost of control account. What goes to cost of control account is ordinary share capital, preferred share capital, and retained earnings. So the total here of the two is a total of 22,000. 22,000. That is the total investment. And this investment was to acquire. So what was acquired with less? Less ordinary share capital. Ordinary share capital. For the ordinary share capital, we have seen that H Limited acquired 60% of the ordinary share capital of S Limited. Now, what we're going to do, we have the ordinary share capital of S Limited to be 30,000, which you can see here. So S Limited acquired only 60% of that. So we are going to say 60% times 30,000. And that will give us 18,000. That is ordinary share capital. Preferred share capital. Preferred share capital equal to 40%. We told that, and 40% of preferred share capital of S Limited. Preferred share capital of S Limited, in this case, you can see equal to 12,000. And H Limited has acquired 40% of them. So we say 40% of 12,000. That will give you 40% by 12 is 4,800. Also, they acquired the retained profit. The retained profit usually is not written as being acquired, but the retained profits usually belong to the ordinary share capital or ordinary shareholders. Therefore, when you acquire ordinary share capital, you acquire it together with the retained profits. So the retained profits that were acquired in this case equal to retained earnings or retained profit is equal to 60%, the same percentage as ordinary share capital. But it is 60% of the following. We are told that at the time of acquisition, the retained profits amounted to 1,000. Therefore, it is 60% of 1,000. And 60% of 1,000 is 600. Therefore, we need to determine the total shareholders fund that was acquired, which we subtract from the investment to determine whether there is positive goodwill or negative goodwill. Now, if we add 18,000, we need to now add the three items. That is 18,000 plus 4,800 plus 600, so that we determine the total shareholders fund that was acquired on the date of acquisition. That will give us a total of 23,400. So we have a total of 23,400. That is the total of the three. 23,400. Now subtract the 23,400 from the total investment that was made. And if you subtract that from 22,000, you get a negative goodwill of 1,400. That is negative goodwill. So that is the goodwill on the date of acquisition, which is negative. It is negative because what was acquired has a greater value than the amount which was used to acquire it. That is how to prepare the cost of control account. We can also prepare this cost of control account using the T account format. Whichever you find easy to use, you can go with the T account by saying, for the cost of control, we have both debit and credit side, as you always know. In that case, we're going to have a T account like this. with the debit side, credit side. And on the debit side, we have the investment, which is investment. And this investment is in ordinary share capital, which is equal to 12,000. Preference share capital, which is equal to 10,000. That is the investment. But this investment was used to acquire the following: ordinary share capital, which I've calculated already. We have found that is 18,000. That is what was acquired. We have calculated preference share capital that was acquired. We have found that is 12,000. We have calculated retained profit, and we have found that it is equal to 600. Then we have goodwill. Now, in case of this goodwill, we have found that the investment is less than what was acquired. Therefore, there's a negative goodwill, which will appear on this side. So we have goodwill on acquisition, and the goodwill on acquisition is the difference between the two sides, which is equal to 1,400. That is a negative goodwill. So we have a total of 23,400, and this side 23,400. That is if we use the T method or the T account to prepare what is called cost of control account. Any of the two methods are correct. Let us now determine the minority interest. And as I've explained, the minority interest consists of the ownership of other shareholders who are not members of, or who are not shareholders of the holding company. So the minority interest usually consists of minority ordinary share capital. It consists of minority share of preference share capital. It consists of minority share of retained profit. So that is what we need to put together. Loan stock is also not forming part of minority interest. Therefore, to determine the minority interest, then we are going to prepare an account as follows. This again, we can prepare using the two methods. Either we can prepare it using the T account method or the vertical method. Whatever you find easier for you, I can illustrate both of them. So if we have the minority interest account, we prepare as follows. If we are using vertical, then we just say minority interest account will be prepared as follows. We begin with the ordinary share capital of the minority. Remember, we had said that the H Limited acquired 40% of ordinary share capital of the subsidiary. Therefore, it means in S Limited, what remained with the minority is 40%. Therefore, we're going to have 40% of ordinary share capital, and the ordinary share capital of this company we found to be 30,000. Therefore, we're going to take 40% of 30,000. 40% of 30,000 will be 12,000. To that, we add preference share capital, and preference share capital, H Limited acquired 40%. It means the minority remained with 60% of preference share capital. Therefore, we are going to have 60% times preference share capital of this company. We have seen is 12,000. So we are simply going to take 60% of 12,000. Now, 60% of 12,000 is equal to 7,200. Next is the retained profit. Remember, I explained that wherever there is ordinary share capital, it goes together with the retained profit because retained profit belongs to the ordinary shareholders. Therefore, we're going to take retained profits of the minority, which equal to 40% of the retained profit of the subsidiary. We simply take the retained profit of the subsidiary the way it is. Whether it is post-acquisition or pre-acquisition, all of them belong to the minority. interest. Therefore, just multiply 40% by the retained profit of subsidiary, which is equal to 4,000. That will be equal to 1,600. Now we add the three items where we have 12,000 plus 7,200 plus 1,600. Now that is equal to 20,800. So the minority interest is equal to 20,800. 20,800. If we prepare this using the T account method, we are going to have an account that looks like this. We have a minority interest account. Minority interest account, which has on the credit side, ordinary share capital of the minority, 12,000. Preference share capital of the minority, 7,200. And then retained profit of the minority, 1,600. So that we have a total of 20,800. So on this side, we have a balance carried down of the minority of 20,800. So that is what we are going to have as the total of this account. Right. Again, using our example to illustrate group retained earning, then group retained earning is determined as follows. If we want to determine the group's retained earnings, using this example that we have been using, we have determined that, or we have said that the group's retained earning consists of retained earnings in H Limited, which is the holding company, retained earnings in H Limited, which is the holding company. In this case, the retained earnings in H Limited, we have determined the retained earnings in H Limited to be equal to 20,000. So that is what we start with, 20,000. That is the retained earnings in the holding company. And then we have retained earnings in the subsidiary company, but we only look at what belongs to the shareholders of the holding company. And we only add post-acquisition retained earnings, not the retained earnings before acquisition. The retained earnings before acquisition, we have already used to calculate goodwill. So we only take retained earnings after acquisition. Now, the total retained earnings of subsidiary is 4,000. Let us now see. H Limited retained earning in S Limited. Now that is what we take, but we take only post-acquisition, meaning after acquisition. That is going to be 4,000, which is the total, minus pre-acquisition retained earnings, which is 1,000. So we remain with 3,000. Then that 3,000, which is remaining, multiplied by 60%, because only 60% of these retained earnings belong to the group. Otherwise, 40% will belong to minority. And we have seen how to determine minority interest above. So we multiply this by 60%, because that is what belongs to the group. That will be 3,000 multiplied by 60%, and that is equal to 1,800. And that is the group's retained profit, which will be equal to 21,800. If we are preparing that using the T account method, as I have been illustrating before, then you can have group's retained profit to be equal to H limited. In H limited, the group's retained profit is equal to 20,000. That one you don't have to calculate anything. And in S limited, the group's retained profit, which should be included, we have calculated above there. It is 4,000 minus 1,000. We can say 4 minus 1 multiplied by 60%, 0.6, and that will give you 1,800. So that the total group's retained earnings is equal to 21,800. This side we say balance carried down for the retained earnings is equal to 21,800. That is how to prepare the same using the T account method. Let us also illustrate the loan stock using our example that we have been using. Now, we understood at the beginning that loan stock should not be added when determining goodwill in the cost of control, or loan stock is not part of the cost of control, even if loan stock has been acquired by the subsidiary. And also, the loan stock that should be shown in the balance sheet is only the loan stock that is owed to the third parties, the owing to the third parties. The intercompany owing should be cancelled, meaning what the subsidiary is owing the parent company should be cancelled, and what the parent company is owing the subsidiary should also be cancelled. Now, in this case, we can see that H Limited acquired or took over loan stock in S Limited amounting to 5,000. The loan stock of S Limited is equal to 6,000. The loan stock in S Limited is 6,000, but H Limited acquired 5,000, meaning in the 6,000, there is loan that is owed to H Limited, which is the holding company. The loan stock which is owed to the holding company should be cancelled. Therefore, we are going to cancel 5,000, and here we cancel 5,000. That means if we subtract 5,000 from 6,000, the loan stock remaining is only 1,000. The loan stock in the holding company is owed to the third parties. And the loan stock which is owed to the third parties in the subsidiary is 1,000. Because 5,000 is owed to the parent company, which is H Limited, and 1,000 is owed to the third parties. The one in the holding company is owed to the third parties. Only loan that is owed to the third parties should be shown in the balance sheet or in the statement of financial position. Otherwise, loan that is owed to others within the group, loan that is owed to the parent company or is owed to the subsidiary should be cancelled out. Therefore, we are going to cancel an amount of 5,000. We are going to cancel an amount of 5,000 in the subsidiary loan stock with 5,000 that H Limited invested as part of the loan stock in S Limited. Therefore, the loan stock is going to be determined as follows. That should be presented in the balance sheet, should be determined as follows. Combined or consolidated loan stock. Consolidated loan stock will then be determined as H Limited's loan stock H Limited loan stock is equal to 10,000. Then S Limited's loan stock but we only take the one to third parties. the one to third parties in S Limited. So we take only 1,000. So that the total loan stock is going to be equal to 10,000 plus 1,000, and that is equal to 11,000. That is the loan stock. Or that is the loan that this company owe to third parties. 11,000. Let me now prepare the group's statement of financial position or consolidated statement of financial position using the illustration example that we have looked at from the beginning. As I said, this is a very simple example, but more advanced examples will come as we continue. The example is as follows. Set out below the draft statement of financial position of Home Limited and its subsidiary Safari Limited as of 31st December 2021. Now here we have non-current assets, which are tangible PPE, and investment in Safari Limited. Then we have current assets. We have total assets, as you can see. Then we have capital, where we have ordinary share capital, preferred share capital, and retained profit. We have non-current liabilities, which is the loan stock, and then we have the current liabilities. There is additional information saying that H Limited acquired the ordinary shares of Safari Limited, 60% of ordinary shares of Safari Limited. When the retained profit was 1,000, it also acquired 40% of preferred shares of preferred share capital and part of the 10% loan stock. Now we have prepared various adjustments which we are going to use to prepare this particular statement of financial position. We are required to prepare the consolidated statement of financial position for H Limited and its subsidiary Safari Limited on 31st December 2021, which we prepare as follows. Now this is Home Limited Group. The statement of financial position. As at 31st December 2021. Now, to prepare this consolidated statement of financial position, we are going to start with non-current assets. And for the non-current assets, we have the non-current assets for Home Limited plus the non-current assets of Safari Limited. So we add 50,000 plus 40,000. That is the non-current assets of Home Limited and the non-current assets of Safari Limited. That will give us tangible assets, which are the PPE, to be equal to 90,000. That means we have added the two. 40,000 plus 50,000, that is 90,000. Then when we come to investment in S Limited, this investment is going to cancel out. We are not going to present the investment in S Limited because that investment is investment on the shares of ordinary share capital here, preferred share capital, and retained earnings of S Limited. So the investment done by Home Limited in S Limited is going to cancel with the items of ordinary share capital, preferred share capital, and the retained profit that was acquired. So we are not going to present it in the statement of financial position, consolidated. Now we're going to have the next item after having tangible PPE is goodwill. In consolidation of S Limited, there was a goodwill which was realized, which was a negative goodwill. And we determined that goodwill when we were preparing the statement, the cost of control account. So the cost of control account, we determined goodwill. Let us go back and see what it was. Right, here is the cost of control account we prepared earlier. In the cost of control account, we realized that goodwill was a negative 1,400, or this one here, 1,400, negative. You remember this when we were preparing the cost of control account. That goodwill of 1,400 negative is what we want to put there. So in the statement of financial position, we have a negative goodwill of 1,400. And now we add, we have 90,000 plus negative 1,400. So we are going to have 88,600. That is the non-current assets. Let us go to current assets. Now, for the current assets, we also add the current assets of the subsidiary plus the current assets of the parent company, so that for inventory, for example, inventory, we are going to have 12,000, which is for Home Limited, plus 10,000, which is for Hess Limited, so that we're going to have a total of 22,000. So we have 22,000 here. That is the sum of the two figures for Home Limited and Safari Limited. Next, we have accounts receivable. Accounts receivable also, we simply add 8,000 plus 4,000. That is this one plus this. We add them so that we have 12,000. For the money in the bank, we have 3,000 plus 2,000 cash at bank. And that gives us 5,000. That is if we add 3,000 plus 2,000 for subsidiary and parent company. The total of the two is going to be we have a total of 39,000. The total is 39,000. So we have 39,000, which now we have as the total non-current, the total current assets. Current assets is 39,000, which we now add to 88,600. So we have 39,000 plus 88,600. That will give us 127,600. $127,600, and the 127,600 is called total assets. That is total assets, and you can underline this double to mean this is total assets. Now let us go to the capital part of it. When we go to the capital area, then we want to say this is capital and liabilities. Capital and liabilities, which is beginning with ordinary share capital, ordinary share capital, and ordinary share capital here, when we present it, we only present the ordinary share capital for the parent company and not for the subsidiary, because the one for the subsidiary was acquired by the parent. And therefore, the ordinary share capital of the subsidiary, which has been divided between the parent company and the minority, now has been cancelled out by this investment, is cancelling the share capital of the subsidiary, which has been divided into the part which is owned by the parent company and the part owned by the minority interest. So therefore, we are going to present only the ordinary share capital of the parent company, which is 50,000 here. Preference share capital also acquired, so we are going to present only for the subsidiary. That is 10,000. Then you're going to have retained profit. Now, when we come to the retained profit, then we are going to include what's called group retained profit. We had determined that earlier when we were talking about adjustments. So the retained profit that is going to be included here is the group's retained profit, which has already been calculated. So what did we determine for the group's retained profit? We determined the group retained profit to be equal to a balance or a total of 21,800, or it is the balance carried down here of 21,800. That is what we're going to include as the group's retained profit, 21,800. $21,800 is the group's retained profit. Now, this is about the capital. And once we determine that capital, we can add to it what's called minority interest, which is also some part of other capital. So the what belongs to the group in terms of capital is the total of the three. And if we add the total of the three, what we are getting is 81,800. So we have 81,800. We want to add to it minority interest. And we had calculated minority interest already. The minority interest, the calculation was up here. I want to take you back there just to refer to it because it is something that we had already determined. And we determined minority interest to be equal to 20,800. You can see that, or it is this balance carried down of 20,800. We calculated that earlier. Refer to our calculation in the video. You can go back and just view whatever we talked about as the determination of minority interest. But you can see it here. Minority interest was determined to be 20,800. So we need to add that. So that we have here a total of 20,800 added. Now, if we add 20,800, we're going to have 102,600. 102,600. 102,600. This is the total of minority interest plus also the capital of the parent company. Right, to this we are going to add liabilities. So we start with the non-current liabilities. And the non-current liabilities equal to 10% loan stock. And we also determine the 10% loan stock, the one that belongs to the group loan stock. And we determine that the group's loan stock was equal to 11,000. You can see the 11,000, whereby we talked about the 11,000 to be determined as follows. First, we began with the loan stock that belonged to we began with the loan stock. That is the amount that is owed to the external people by the Hedge Limited or the parent company. The amount that the the parent company is owing third parties is 10,000. Then we talk about the amount that is owed by the subsidiary, that is owed to the third parties by the subsidiary. The third party is owing the subsidiary is the following. The third party is owing a total of 6,000, but part of the 6,000 is owed to the parent company. The parent company is owed 5,000. So then we say that you need to deduct that 5,000, which is owed to the parent company, from all the loan stock, so that we remain with only 1,000. 1,000 is what we added to this 10,000 to give us 11,000. So now we're going to add the group's loan stock to be 11,000 and not 16,000. So we have here 11,000. 11,000. After that, we go to current liabilities. And the current liabilities consist of accounts payable. And for the accounts payable, we just simply add the two. Add the one which is owed by the parent company to the one which is owed by the subsidiary, so that we have a total of 10,000 plus 4,000 to be 14,000. That is the accounts payable. Right. So if we add 11,000 and we add 14,000 to 102,600, we're going to get a total of 127,600. Now that is going to be the same as what we had calculated before as the total assets. Now, what simply we can see is that when we're preparing consolidated statement of financial position, is simply aggregating the items of income of statement of financial position for the parent company and the subsidiary, but taking into consideration the adjustments that we made before we start preparing the statement of financial position.